Great, thanks so much. I'm Randy Cohen. I teach finance and entrepreneurship at Harvard Business School. I co-founded PEO Partners with Jean-Louis Leleger. Jean-Louis couldn't be here today, he's here by Zoom, but he co-founded Strategic Value Partners about 20 years ago. Some of you may have invested in SVP. They've had phenomenal returns over the 2 decades and now manage about $18 billion. He stepped into a senior advisor role there so he could start PEO with me. I feel like just given where we are in the world, I should say something about the Omicron variant. So here's, you learn the best stuff from your kids, right? It's the stuff you feel like, how could I not have known that my whole life? So here's the thing you can say at a cocktail party about the Omicron without frightening anybody or upsetting anybody, which is, and if everybody knew this but me, apologies for wasting your time. So the last letter of the Greek alphabet is omega. Omega is Greek for big O, right? Mega means big, right? And there's this letter in the middle of the Greek alphabet called Omicron, O-micron. That means little o, right? So now you know. All right, so this is the little o variant. All right, let's talk about PEO, which is neither big nor little. So what are we doing with liquid private equity? I have been for 20 years researching and proselytizing the idea of liquid private equity. And what do I mean by that? Private equity has been the best performing asset class in the world for decades. And when I say best performing, I don't just mean that the returns are above the S&P 500 index by 2-3% a year, although that is true. And that's average PE, not top quartile. That's the average. 2 or 3% a year above the index. But also, when the market crashes, PE doesn't go down that much, right? Which is phenomenal. Okay, and then also the correlation between PE and stocks and bonds is low enough that if you have a, say, 60-40 stock bond portfolio and you add private equity to it, you lower the volatility of your overall portfolio through the power of diversification, right? So that is that is a really powerful combination of 3 great portfolio attributes, and that's why PE is so great. So what's wrong with PE? Oh, and by the way, as a result of this, if you wanted to nutshell the last 30 years of institutional investing, what you'd say is they went from 60-40 to 50-30-20. 60% stocks, 40% bonds has sort of shifted over time. Of course, there's other stuff out there. There's other kinds of credit that isn't really bonds, whatever. But ballpark, it's not too crazy to say they went from 60-40 to 50 in stocks, 30 in bonds, and then 20 in PE. Now, when we say liquid PE, it is our plan over time to create all kinds of PE. We can have liquid venture capital. We can have liquid infrastructure, liquid real estate. But you have to start somewhere. And so we started with the area that is the dominant part of the private equity landscape, and that is leverage buyout, LBO. Okay, so when I say liquid PE in this talk or talk about PE, unless I explicitly say differently, I'm talking about liquid LBO. Okay, now I should add, as you may have noticed with the stick, I'm blind, so I can't see if you put your hands up. I am eager for interaction. I do have a lot to say, but I will try to leave time for questions at the end. If I run out of time, or if we have more questions than there's time for, I am leaving for the airport at 5:30 a.m. tomorrow. Between now and then, I will take any question from anybody, anywhere. So just grab me after this, at dinner, after dinner. I love to talk about this stuff. What's wrong with PE? Why not just put all your money in PE if it delivers such great performance? Well, of course, you should never put all your money in anything because diversification is so important. But why not put even more into it? Well, there's 2 problems, liquidity and access, right? So the access, let's do access first. Some people simply can't invest in PE, right? They may not be able to invest because they're a retail investor with 80 grand in their 401k plan and you can't meet the minimums of PE funds. Or they may not be able to invest because they're high net worth, but they're not ultra high net worth. Suppose you retired with $8 million. That's a wealthy, successful person. But if you want to put 20% in PE the way a typical institution would, that's $1.6 million. $1.6 million will barely make the minimum of 1 private equity fund, which is going to have maybe 8 positions in the portfolio. You do not want to have 20% of your money in 8 tiny illiquid companies, right? You want to have 20% of your money in a diversified portfolio of PE holdings. But for that, you need to have 50, 100, $200 million. Many of the people in this room or on this call may, in fact, be at that wealth level, which is great. We'll get to you in a moment. But for people who are wealthy but not that super duper wealthy, then liquid PE would be interesting because PE is limited. Also, many institutions, I sit on the investment committee of my kid's school. We are not big enough to invest in private equity. Accounting firms have conflict rules, insurance companies have capital charge funds. Lots of people don't have the ability to access PE. Okay, so that's one group that would be interested in liquid PE to fill the part in their portfolio that they can't put into PE because they can't access PE. What about people who can access PE? Are we arguing that they should replace their PE with liquid PE? We are not. You will never hear me say that anybody should take $1 out of private equity to put it into liquid private equity. That is not our case. Our view is that if you have access to PE and you have the ability to pick high quality PE funds and get into them, you should do that. And then why would you care about liquid PE? Because it turns out that managing a private equity portfolio is hard. It is hard and it is complicated, and there are lots of moving parts. And in order to manage that portfolio well, you need tools in the toolbox. And there are a few tools out there. You can invest in secondary funds. You can do co-invest if you're big enough. If you have the right team, you might be able to do direct investing. There's PE fund of funds. That's about it. It's not a fantastic array of tools, but it's sure better than what we had 20 years ago, which was nothing, right? But we want to add another important tool to the toolbox, and that is liquid private equity. Okay, so what is this tool good for? What could you use it for? Well, let's start with this. Suppose that you were successful but didn't have a big portfolio you managed, and then you sold the business that made you successful, and now you have $100 million, right? So maybe you want to make a traditional portfolio, not traditional really, but a modern investment portfolio that endowment might have with 20 or 25% PE, let's say 20. So you want to put $20 million into PE. Great, go out and identify 15 amazing private equity funds, allocate to those funds. You're in great shape, except you will be in great shape in 7 years after the $20 million has been drawn down. Right now, you have nothing in PE. You just allocated to some funds that haven't drawn down capital yet. But you don't want to go 7 years not allocated to the highest performing asset class. So what we say is allocate to those 15 funds, but also put $20 million into liquid PE. And then every time you get a capital call from one of those 15 funds you chose, take the money out of liquid PE and put it into traditional PE. So you'll immediately be at 20% PE, all liquid. And then over time, you'll migrate towards having almost the whole allocation in traditional PE. Why do I say almost the whole allocation instead of the whole allocation? Because anybody who's run a PE portfolio knows you need a buffer of capital to hold the money that is going to be capital called soon, but you don't know exactly when. Will it be in 2 weeks or will it be in 2 months? You're not sure. Or suppose you make a great investment. You put money with a terrific fund firm like Blackstone. They put your money to work. Home run, grand slam, they send you back $80 million. Where does that $80 million sit while you're waiting for the next set of capital calls? It should sit in liquid PE. Right now, people are putting it in cash, which returns nothing, or into stocks, which if they crash, you then don't have any cash to make your capital call with. For future capital calls. And by the way, at the juiciest possible time, right after a crash, that's when you won't be able to make capital calls. Or they put it into 60-40, which I'll say a few words about, because similar to Richard before me, I have serious concerns about 60-40 and think that anybody with a lot of money in 60-40, which is almost everybody, should be looking at alternatives, and we think liquid PE makes sense as an alternative there. So you have a use case as a funding asset solution, a liquidity buffer for the cash that is waiting to be capital called. And so that's why I say even in the steady state of 20%, you should probably imagine a typical 20% PE portfolio is more like 18% PE and 2% in the buffer. And we think that buffer should be liquid PE, not cash or the index or 60-40, right? And there's lots of other use cases. If you have specialized ESG desires, suppose that you're very concerned about climate change, but at the same time, you think defense contractors are, hardworking, noble soldiers, engineers, and so forth who are working to keep us safe while we lay in our beds at night, right? And that they are not people who should be pushed out of the portfolio, but people who should be heavily included in the portfolio. Well, in a public markets portfolio, fine, you can pick the stocks that meet your needs. It's going to be really tough to find an ESG private equity fund that agrees with you on both those issues, let alone 8 other things that you might believe strongly about in terms of what constitutes proper ESG investing. But with liquid PE, you can customize an ESG portfolio that meets exactly your needs, right? Or completion portfolio. Say you do a lot of direct investing, or say your family business is heavily allocated to manufacturing. Well, then you don't want all your private equity investing to also be in manufacturing. You'll have a huge overweight, right? But if you invest in a traditional private equity fund that has flexibility in what asset classes they're in, or sorry, what sectors they're in, you can't say to them, hey, but by the way, if you do something in manufacturing, leave us out of that one, right? But with liquid PE, you can customize what you need. So there's a million use cases for this. That brings us then to the question, does it work? Can you deliver the performance in liquid PE? There are two ways to think about that question. One is, logically, should you be able to match the performance of traditional PE in a liquid portfolio? And the second is, historically, would the methods that logically ought to work have worked, right? If you don't have both the logic and the history, then you shouldn't believe in it. And that applies across all investing, right? Anybody who's telling you you should invest in X, they should be able to show you first that logically X ought to work, and second, that historically X has worked. If it logically should work, but it hasn't worked, probably you left something out of your logic. If it's worked historically, but logically it doesn't make any sense, there's a really good chance it's data mining. So you want to have both. Now, I'll just tell you, because I'm blind, I don't work with slides. So what I'll say is, historically this has worked. I'm going to describe to you what we do, and I'm going to tell you why logically it should work. And then I'll tell you that you can look, and our slides are posted, so you can check it out. I mean, Jean-Louis and our whole team, we have a big team at PEO Partners. Of course, we have done all that historical back testing. I worked hard on it. I'm a finance professor, so I know how to do that analysis. I don't write as much code as I used to because I'm blinder now, but I worked with the team and we all wrote the code together. And I can tell you this absolutely works, and you can check it yourself 7 ways from Sunday, and you will see that and talk to us, and we'll dig into that. So that one, I'm just going to tell you, and then you got to check it for yourselves, because we're not going to spend a lot of time walking you through the back tests. What I will spend time on is telling you what we do and logically why you should expect it to work, why it should not surprise you when I tell you that it works. Okay, so what are we going to do? The key thing to realize is we have the data on the holdings of all 1,100 or so LBO firms in America, okay? Cost us a fortune to get this data. It wasn't even available until last year, but now it's available and we have it, and we were able to do the analysis. So once you're in possession of that data, 3-step process. Step 1, identify a set of US public companies that looks as much as possible like the set of 10,000 private companies in those 1,100 or so LBO portfolios. Okay, so we're going to end up with a portfolio of, called 180 stocks. Maybe more, maybe a few hundred. Let's say generally a few hundred stocks. So we have a portfolio of a few hundred companies that looks as much as possible like, that matches the characteristics of what LBO holds. Okay, of course it's not the same companies. Those companies are private. We can't buy them. Right? We're like public companies that look like them, and I'll tell you exactly what that means in a moment, right? By the way, we are completely transparent. I will tell you literally exactly what we do, okay? So second thing is we're going to lever. Remember, the L in LBO stands for leverage. So those funds are levered, and so we have to lever. So we're going to lever the same amount as they do. It's not that much, but it's enough to make a meaningful difference. And then third, we're going to hedge. Now, PE doesn't explicitly hedge, but PE does have the feature that when the market crashes, it doesn't go down that much. So why are we going to hedge? We have to make sure that we also don't go down that much when the market crashes, okay? And we do that. And that is really important because, as I say, one reasonable comp for what we're doing is 60-40. And 60-40 is in a terrifying state. I'm writing a paper on 60-40 with my colleague, Luis Becerra, who's probably the world's expert on stock bond correlation in the 60-40 portfolio. Now, the history here is really clear. 60-40 has shot the lights out. As a finance professor, I am proud that a fellow finance professor, Nobel laureate Harry Markowitz, created something so powerful and effective. Over the last half century, what we've seen is about 9% annual returns for 60-40, and only once in half a century have we had a year where the 60-40 lost double digits, which was 2008, and even that year, basically, you got it all back the next year. So 60-40 has been pretty darn low risk, pretty darn high return. 9% a year for a lifetime gets you 1,000 times your money. It's been amazing. What's the problem? The problem is going forward, the future is going to look nothing like the past. First, what are the bonds going to return? The long bond is paying less than 2%. So if you hold the longest of long bonds, you'll make 2%. If you hold shorter bonds, you'll probably make less, right? What about stocks? Stocks are priced to return about 5% a year for the next 30 years. I have no idea what stocks will do tomorrow, next month, next year, but I can tell you that over the next 30 years, they're going to make about 5% a year. If we get way more economic growth than expected, maybe they'll make 6 instead of 5. If we get less, maybe we'll make 4. If there's a boom right at the end of 30 years from now, maybe you'll get an extra % a year, because that boom pushes price up 30%. You got to spread it over 30 years. So you're going to make about 5 in your stocks, 2 in your bonds. 60-40 weighted average gets you in the high 3s. And that's before you pay any asset manager fees, anything. Okay, so that is a long, long way from 9% a year. But that's not the scariest part. The scariest part is the risk. See, historically, when stocks crash, your bonds protected you. And if you get a stock crash, if people get afraid of the growth of the economy, that it's not going to be there, yeah, then bonds will protect you. But a stock crash is not what we're all afraid of right now. We're afraid of a bond crash. We're afraid the long bond is going to go from 2 to 3%. Bond math tells you that if the long bond goes from 2 to 3%, your bonds are going to lose 30% of their value. And your stocks are going to fall as much or more because the duration of the stock market is longer than the long bond. So you're going to lose 30+% on the whole 60-40 if we get that interest rate move that everybody feels. If there's a lot of inflation and the Fed has to act and push long bonds, not to 7, not to anything crazy, just back to 3 like they were before the pandemic, then we're going to lose a third of our money in 60-40. So if we can show you something that will deliver stock-like or better returns and not crash in a crash, it's got to be awfully attractive. Okay?
Randy, we got about 3 minutes.
3 minutes, great. So how does PE add so much value, right? There's 6 things they do, okay? First, they lever. We're going to lever the same amount. How much is that? It's about 1.4 to 1. Typical public company is 30% debt. A typical LBO-able public company, the kind of public company that has all the cash flow you need in order to make the interest payments on an LBO, is about 50% debt. LBO deals are about 70 or 75% debt, so about 1.4 times levered. Our products, by the way, we have 2 products out in the market. One is only for Canadians, I'm sorry to say, but the other anybody in the world can invest in. And the Canadian one's been around since 2020, and the one anybody can invest in launched in May. Okay, and so so we're going to lever just that little bit, 1.3 or 1.4 to 1, to match what PE does, so we can match that source of value added. Second, we're going to match the crash protection of PE. PE protects against a crash by using mark-to-model accounting. When bad news happens, PE says, you know what, we think the market's overreacting, we're not going to take too big of a markdown. We're not allowed to do that because we're in public companies, so we buy put spreads to hedge. We have a sophisticated put spread strategy developed by our partners at Gladius Capital, who are top derivatives experts. Okay, so that's 2 that we can match. Okay, we can also match the fact that PE is fantastically good at picking industries. PE has consistently been tilted towards the right industries for decades. That is established in multiple academic papers and in our own research. We know what industries they're in every single quarter, and we can match their industry allocation, and we do. Then the 4th thing PE does that's great is they pick the right companies within industries. What are those? If I have more time, I go into more detail, but I can give you the gist in 2 seconds. Low multiple, high profitability companies. That's what PE does. Because after all, if you're going to pay out, if you're going to borrow 3/4 of the money in the deal at 8%, which means 6% a year of enterprise value is being paid every year in interest, you had better have high cash flows. And so those are high profitability companies, but they can't buy them at high multiples or the money or the numbers don't work out. So high profitability, low multiple, guess what? Those are the best performing companies in the stock market. So that's what we buy, and it's what LBO firms buy. So we match that. So what can't we match? We can't match the operational improvements that PE makes. We can't get in there the way I've been sending my best students for 25 years off to these LBO firms. They do a great job. They use inside information to decide what companies to buy. We're not allowed to have inside information, but they are. And they make operational improvements after the deal is done. That puts us behind by 1 to 2% because we don't have inside information per year, another 1 to 2% because we can't make operational improvements, and another 1 to 2% because we have to pay for those options. Insurance costs money. So that puts us 3 to 6% behind PE, but we have advantages too. And there's more than one, but I'm just going to say one so I don't go over my time. And that is the typical private equity firm, once you add up operating fees, monitoring fees, origination fees, management fees, and carried interest, charges about 700 basis points a year in fees. Our product is about 100 basis points a year in fees. That 600 basis point gap takes us from 3 to 6% behind, 1 to 2 plus 1 to 2 plus 1 to 2, 3 to 6% behind on gross returns compared to traditional PE, to 0 to 3% ahead. Now on the back test, it's closer to 3% ahead. You're never as good as your back test. We believe we can match the average performance of traditional LBO firms, which is 2 to 3% ahead of the stock market, while also matching the downside protection so that when the market crashes, we deliver solid returns around 0, maybe a little less, maybe a little more, but not crash-like returns. And if we can do that, it is not a reason to replace any of your PE with liquid PE, because top quartile PE will beat us. But it is a reason to use us to help manage your private equity portfolio around the edges. Thanks so much.